Most companies don't lose billions of dollars all at once. When a company is in trouble, it usually happens slowly. Sales decline, profits shrink, layoffs begin, and over time the company loses value. But sometimes, a company can lose an unbelievable amount of money in a single day. On July 26, 2018, one of the biggest and most successful tech companies in the world reported its quarterly earnings. The company was profitable, it was still growing, and it still had billions of users. But after that earnings report, the company lost more than $100 billion in value in a single day. This is the story of how a company can lose billions overnight, even when it isn't going bankrupt, and why expectations can be more dangerous than failure. The company was Facebook. To understand how this happened, you have to understand how the stock market works. When you hear that a company lost billions of dollars, it usually doesn't mean the company physically lost that money. It means the company lost market value. Public companies are divided into shares, and those shares are bought and sold by investors. The total value of all those shares combined is called the company's market value, or market capitalization. If investors believe a company will grow and make more money in the future, the stock price goes up. If investors believe the company will grow slower than expected, the stock price goes down. And for very large companies, even a small change in stock price can mean billions of dollars gained or lost in a single day. In 2018, Facebook was one of the most powerful companies in the world. It had over 2 billion users, it dominated social media, and its advertising business was incredibly profitable. For years, the company had been growing fast, making more money every year, and investors expected that growth to continue. But there was a problem. By 2018, Facebook had already captured most of the people in the world who were likely to use Facebook. Growth was starting to slow down, especially in the United States and Europe. At the same time, the company was dealing with increasing criticism about privacy, data usage, and its influence on politics and society. Facebook decided it needed to make changes to the platform. The company announced it would start focusing more on privacy and on showing users more content from friends and family, and less content from businesses and advertisers. This was probably the right long-term decision for the platform, but it had a big short-term consequence. It meant Facebook would make less advertising money, at least for a while. When Facebook reported its earnings in July 2018, the numbers were still good, but the company warned investors that revenue growth would slow down in the future and that costs would increase as the company invested more in security, privacy, and content moderation. Investors did not like that. The next day, Facebook's stock dropped about 19%. In one day, the company lost more than $100 billion in market value. It was the largest single-day loss in stock market history at the time. Nothing had exploded. No factory burned down. The company wasn't going bankrupt. It was still making billions of dollars in profit. But the company had told investors that growth would slow down, and on the stock market, growth is everything. This is one of the most important lessons in business and investing. Companies are not valued based on what they are today. They are valued based on what investors think they will become in the future. If investors believe a company will grow quickly, the company becomes very valuable. If investors suddenly believe that growth will slow down, the company can lose massive amounts of value almost instantly. Facebook didn't lose billions because it was failing. It lost billions because it was no longer expected to grow as fast as people thought. This happens a lot in the technology industry. Tech companies are often valued very highly because investors expect fast growth. But that also means if growth slows down even a little bit, the stock can fall very quickly. In Facebook's case, the company was transitioning from a period of hypergrowth to a more mature company that still made a lot of money, but wasn't growing as fast as before. And when that transition became clear, the market reacted immediately. Mark Zuckerberg, the CEO of Facebook, personally lost billions of dollars on paper in a single day because so much of his wealth was tied to Facebook stock. But the company itself continued operating, continued making money, and continued growing, just at a slower pace. In fact, Facebook is a great example of how a company can lose an enormous amount of value overnight and still be a successful company years later. The company didn't disappear. It didn't go bankrupt. It didn't shut down. It just wasn't growing as fast as people expected anymore. And that was enough for the market to erase more than $100 billion in value in a single day. This story is important because it shows that in business, perception can be just as important as reality. A company can be profitable, successful, and still lose billions of dollars in value if investors lose confidence in its future growth. It also shows how powerful expectations are. When a company grows very fast for a long time, people start to assume that growth will continue forever. But in reality, no company can grow at extreme rates forever. Eventually, growth slows down, markets become saturated, and companies have to adapt to a new phase of their life cycle. The companies that survive are the ones that successfully transition from high-growth companies into stable, profitable companies. The ones that fail are often the ones that cannot survive that transition. Facebook survived, but on that day in 2018, the company lost more value in a single day than most companies are worth in total. And it happened not because of a disaster, but because of expectations. Sometimes companies don't collapse because they are failing. Sometimes they collapse because they can't live up to what people expected them to become. And on the stock market, expectations can be worth billions.